Welcome to Know What You Are Investing podcast, where we decode the world's top companies. In this episode, we explore ASML Holdings' third quarter 2025 earnings recap. We'll look at how ASML remains the only maker of EUV lithography machines, the backbone of today's AI-driven semiconductor industry. We'll review their strong Q3 results, future growth roadmap in High-NA and 3D integration, and discuss how geopolitical risks could shape investor returns. Let's get started.
Welcome back to the Deep Dive. Today, we are strapping into what feels like the driver's seat of the entire global semiconductor industry. Because we are plunging into ASML Holding. This isn't just another hardware company. You could argue it's the single most important technical gatekeeper on the planet right now, really determining the speed, the capability of future tech, especially, AI. So our mission today, to crack open their Q3 2025 earnings report. We want to understand their impressive financial health, sure, but maybe more importantly, their strategic roadmap. How do they plan to keep this dominance going to the next wave of AI? And crucially, we need to look hard at the specific high-stakes investment risks. These risks have analysts giving this world-class company a very balanced, maybe even cautious hold rating.
Yeah, and when we talk about ASML, based out there in Veldhoven, Netherlands, you really have to grasp their structural position. Founded back in 1984, they've basically evolved into the core enabler of the whole chip ecosystem. They don't actually make the chips, right? But without ASML's super specialized lithography tools, well, the most powerful logic and memory chips, the ones used in modern data centers, advanced AI training, they just couldn't be manufactured at volume. Simple as that.
Okay, let's unpack that core identity then. Segment one, their technological monopoly. Because ASML's value proposition, it's truly unique. Their portfolio covers, everything from deep ultraviolet DUV systems, metrology equipment, and critically, the one-of-a-kind extreme ultraviolet or EUV lithography systems.
Right. And EUV lithography, that's the key differentiator. It's ASML's ultimate technological moat. For you listening, maybe think of it like this. Making advanced microchips requires printing patterns so incredibly tiny that the light source itself needs to be smaller than those patterns. EUV uses this specific wavelength of light to print these unbelievably intricate circuits that define the latest chips, like 3 nanometer, 2 nanometer. And this tech is just indispensable for high-performance computing, the massive AI infrastructure build-out we're seeing. And here's the punchline, really. There is no one else. While companies like, say, Nikon and Canon are still active in the broader DUV market that's used for older chip generations, ASML is the only company in the world that manufactures and ships EUV systems, period. This proprietary monopoly means every single major chip maker, TSMC, Samsung, Intel, they have to buy their most critical equipment from one single source. ASML, and that gives them unparalleled pricing power.
And that monopoly power, that translates directly into these, truly staggering financial numbers we saw in the Q3 2025 report. So let's decode that scorecard. It confirms why they're seen as this world-class operator that can basically charge what they want. Okay, Q3. Total net sales hit $7.5 billion. That resulted in a net income of $2.1 billion. And the metric everyone watches, net bookings future orders, came in at $5.4 billion. And note this detail. A substantial $3.6 billion of those bookings came directly from the high-margin EUV systems.
Exactly.
So the demand is clearly skewed toward the most advanced, highest-priced tech.
Those headline numbers are great, absolutely, but the profitability, that's what really sets ASML apart. It defines their structural advantage. Look at the margins. Their gross margin was 51.6%.
Wow.
And their net income margin, 28.3%. Now, if you look across the whole semiconductor equipment sector, right, the median net income margin is sitting around 5%.
Just 5%.
Yeah. ASML is generating nearly 6 times the profitability of its average peer. And this isn't just because they're, super efficient. It's because they can dictate terms. They're fundamentally valued by the market, not like a traditional capital equipment maker. Those are usually low-margin, cyclical businesses. ASML is valued more like a software company or maybe even a utility monopoly. They translate that tech lead directly into financial efficiency and, premium pricing.
And that efficiency gets passed on to shareholders, which is where it gets really interesting for investors. In Q3, they paid an interim dividend of $1.60 per share. And they purchased $148 million worth of stock through buybacks. Management also confirmed something important. While their existing $12 billion buyback program won't actually be completed by the end of 2025, they are fully committed to announcing a brand new share buyback program come January 2026.
Right.
That confidence shows they see sustained capital return as, non-negotiable.
Yeah, it does. And yet, Despite this phenomenal financial strength, this technological dominance, the consensus rating is still hold, which reflects this delicate higher wire act, doesn't it? You've got these extreme strengths balanced against equally clear, complex risks, meaning the stock is maybe trading perfectly in line with its current known potential.
Okay, so let's detail that bull case first, because the quant ratings, they love the underlying performance. They score high marks for growth revenue, grew 23% year over year, which, I mean, that absolutely demolishes the sector's 7% median.
Huge difference, yeah.
And their momentum is also incredibly robust. Their one-year price performance was 47% compared to the sector's 10%. And analyst optimism is, well, palpable. You saw 24 upward earnings revisions this quarter versus only 3 downward. That kind of confidence suggests analysts really believe ASML can execute flawlessly.
Which brings us sharply to the bear case. And this is driven almost entirely by price and risk. ASML's stock, it trades at a significant premium, some might say an eye-watering premium. We're looking at a price-to-sales ratio of 11 and a price-to-book ratio of 18. 18. Now, just to put that into perspective, the sector median for those same metrics is around 4.
4 versus 18.
Yeah. This massive premium tells you everything you need to know about the stock, really. The market has already priced in years of future, potentially flawless execution and growth. You are paying a monopoly price for a monopoly company. So if they stumble even slightly, the downside could be significant because the margin for error, it's just non-existent at this valuation.
And the other side of that bear argument, which, we touched on earlier, is the cost of maintaining that monopoly. R&D intensity.
Exactly.
To keep that technological lead so wide, stay ahead of the curve, ASML is forced to spend massive amounts of money. They reported R&D costs of $1.109 billion just in Q3 alone.
Exactly. Over €1 billion. This R&D spend isn't really a business choice for them. It's essentially the moat tax. You have to pay it. And that capital-intensive nature, it raises a key question for the bear argument. How sustainable is that lead? And that necessary spending during a serious macro slowdown? If demand slowed and they were forced to cut back on that €1 billion+ quarterly spending, their technological lead could start to erode. It could open the door for future competitors, although, let's be clear, there aren't any visible right now. They have to spend that money to keep their dominance secure.
Right. It's an essential non-discretionary expenditure. You can't cut it. And that huge investment is clearly tied to their strategic roadmap. ASML views AI not just as some short-term boost, but as a long-term structural growth engine. That's a quote from the CEO. They aren't just selling to the current AI boom. They're fundamentally building the tools for the next decade of AI development.
And their execution on that technology roadmap, that's the primary justification for their valuation, really. First, you have the next generation of EUV, high-NA lithography. High-NA aims to increase the resolution, the numerical aperture, allowing for even smaller, denser patterns on chips. And they reported that over 300,000 wafers have now been run at a customer site using this new tech.
So this is real-world validation.
Yeah, this is production validation, not just lab work anymore.
And the most concrete evidence of that future path is probably the customer commitments, right?
Absolutely. SK Hynix, the memory giant, began installing its first high-NA system, the 5200 model, specifically for DRAM production. Now that's huge because it validates that this incredibly complex multi-billion-euro equipment is now essential for both advanced logic and advanced memory manufacturing. That secures future order flow from multiple angles. But they're also thinking beyond just shrinking features in 2 dimensions. They're moving into 3D integration and advanced packaging. As 2D scaling kind of hits physical and financial limits, chip makers are turning to stacking logic and memory components right on top of each other. And ASML shipped its first advanced packaging product, the XT.260, which boasts up to 4 times the productivity compared to existing solutions.
Okay, just to be clear for everyone listening, why is this 3D stacking suddenly so critical? What's the driver?
Well, it's largely about power efficiency and speed, especially for AI accelerators. If you stack the chips vertically, the distance data has to travel is minuscule compared to sending it across a traditional circuit board. This drastically cuts power consumption and latency, and those are the primary bottlenecks for running these massive AI models effectively. So ASML is making sure they are the enabling technology for how chips are built, whether that's flat in 2 dimensions or stacked up in 3.
Got it. And maybe the most fascinating strategic move this quarter is how their strategy is actually integrating AI into their own process. They made this move into the software side of AI with their strategic partnership with Mistral AI.
Yes.
ASML was the lead investor in Mistral Series C funding round, taking an 11% stake in the French LLM company. That's significant.
It really is. And this is like a textbook example of vertical integration of intellectual capital. See, ASML's photolithography process, it's managed by an incredibly complex array of software. This whole field is called computational lithography. They use these complex models to calculate precisely how to expose the wafer to light, accounting for all sorts of potential errors and distortions. Now, Mistral AI is recognized for the quality of its large language models, particularly, in software coding and development. So ASML is leveraging Mistral's capabilities to improve and accelerate the quality of its own software stack. This enhances their AI-driven computational lithography, potentially allowing their machines to correct tiny pattern defects faster or optimize exposure protocols on the fly. And it could even enhance their internal R&D efficiency by shortening software development cycles.
Wow.
So this partnership ensures that their hardware dominance is reinforced by state-of-the-art software intelligence. It's smart.
That sounds like a massive competitive advantage stacking up. And if we look long-term, management certainly isn't lacking confidence. They reiterated those ambitious 2030 targets, annual revenue between $44 billion and $60 billion.
Huge numbers.
While maintaining a gross margin in the just ultra-high 56% to 60% range.
And those staggering targets bring us directly to segment 5, the geopolitical headwinds, because this is the primary short-term risk, and it directly challenges their ability to hit, say, the high end of that growth projection.
Yeah, let's focus on the China exposure because it's significant. China represented 27% of ASML's total system sales in Q3 2025. That was primarily DUV systems, as EUV sales are already restricted.
Correct.
But still, 27%. That is a massive chunk of revenue tied to a region with constantly tightening trade restrictions.
Yeah, and management was very clear in acknowledging this constraint. They didn't shy away from it. They specifically stated that Chinese customer demand is expected to decline significantly in 2026 compared to the strong business they saw in 2024 and 2025. So this creates immediate, unavoidable revenue uncertainty for the short term. No way around that.
But the company line seems to be that they expect to navigate this. How reliable is that prediction, though? The idea that increasing EUV demand for the rest of the world will fully offset the anticipated DUV losses in China. That seems like a massive leap of faith for investors, especially when you're operating at this premium valuation.
Well, it relies entirely on the aggressive build-out of advanced logic and DRAM capacity happening elsewhere, across the U.S., Korea, Taiwan, Europe. They project that while the China DUV business will certainly lower, the increasing global EUV demand driven by those advanced logic customers building out AI capacity will offset the losses. So this is why management expects 2026 net sales to, quote, not fall below 2025 levels. But the product mix will shift dramatically. They'll sell fewer lower-margin DUV systems to China, but they expect to sell more high-margin EUV systems globally. The bet, essentially, is that the global AI arms race is so demanding that their massive EUV backlog provides a necessary buffer against this geopolitical volatility.
Okay, but regardless of their internal expectations, the conclusion sort of remains the same, doesn't it? The high valuation means the market demands near-perfect execution. Any geopolitical shock that limits their ability to sell any equipment, DUV or EUV, or any unexpected macro tremor that slows the global AI build-out, it leaves very, very little room for error.
Precisely. Look, ASML is an essential, you could say, must-own technology enabler. World-class profitability, unmatched technological dominance. Their moat is incredibly wide. But the near-term investment decision is complicated. You absolutely must weigh that dominance against a high premium valuation and these unavoidable geopolitical constraints, so the hold rating. It perfectly captures that high-stakes balance between technological perfection and external risk.
So what does this all mean for you, the listener? Leads us to our final thought for you to mull over. Given ASML's absolutely critical role in building the foundational tech for AI, and knowing that they have to spend over €1 billion every single quarter just to maintain their technological lead, imagine this scenario for a second. What structural shifts might we see in the semiconductor ecosystem if geopolitical pressure were to suddenly completely ease? Would the immediate unfettered access to new major markets for their high-NA and EUV systems just push their valuation even further into the stratosphere? And how quickly would that happen?
It's the ultimate counterfactual question, isn't it? Because the future of silicon really hinges on the political constraints surrounding this single Dutch manufacturer.
It absolutely does. Thanks for diving deep with us today.
We'll catch you next time.
That wraps up our ASML third quarter 2025 earnings recap. ASML continues to define the semiconductor industry, a company at the center of innovation, but also at the crossroads of valuation and geopolitics. Thank you for listening to Know What You Are Investing podcast, where we decode the world's top companies, what they do, how they grow, and why it matters. See you in the next episode.